Welcome to the Opening Bell Report.
Today, we're looking at a financial situation that, honestly, it feels like it shouldn't be possible.
It's a genuine anomaly.
Total anomaly. We're talking about a company listed on the NASDAQ. The ticker is YYAI, that's RWA Inc. And the market's valuation is basically telling us that the business itself, the operations, the tech, it's all worth less than nothing.
Right. It's some truly bizarre math.
I find it hard to even wrap my head around. If we look at the Q2 filing again, the market is giving this company a cap that is just so much less than the actual verifiable cash it has in the bank.
The numbers are pretty stark. Based on those Q2 2026 figures, the market cap for RWA is hovering right around $47.8 million.
Okay, $48 million.
But then you look at their liquid assets, the cash on hand, and that's approximately $132.36 million.
Wow.
Yeah, so that gap, almost $85 million, that's really the core of what we need to unpack today.
So our mission is clear then. We have to figure out what nightmare scenario the market is pricing in to believe a company will just burn through $85 million of its own cash. We have to look at the new business model, the risks, and figure out if this is a real deep value play or just a classic value trap.
It's a staring contest, really, between a massive, verifiable pile of cash and a potentially massive black hole spending problem.
All right, let's start with the math, because that's what defines the entire opportunity here. It's a classic negative enterprise value situation.
Exactly.
And when we say that, we're not just saying the stock is, cheap. We're saying the actual operations, when you strip out the cash, are valued at a negative number. So for you listening, the implication is huge. Let's just break this down. If you could theoretically buy the entire company today for that $47.8 million,
you would immediately get control of their bank account,
which has $132 million in it. I mean, if you do the quick math, you're paying roughly 36 cents for every dollar of cash they have.
Paying 36 cents to get a dollar back instantly.
Yeah, and we should probably clarify the balance sheet right away.
Good point. Because the first question is always, what about the debt?
Right. Is there some hidden leverage?
Almost none. It's about $57.8 million.
Yeah.
So in this context, it's negligible. It's basically nothing.
So no debt, $132 million in cash, and a market value under $50 million.
Which leads to the big logical question. Why? If it's this simple, why hasn't a hedge fund just bought the whole thing?
Exactly.
And the answer, the one fear driving all of this, is what the analysis calls extreme cash burn. The market has absolutely zero confidence in the current management team and their plan.
Zero confidence. Okay, that's a strong statement. But hold on a second. If they have all this cash and the market doesn't trust their strategy, why didn't they just do a massive share buyback?
That's it. That is the multi-million-dollar question.
I mean, isn't that the most direct way to fix this disconnect? To reward shareholders instead of, betting it all on some speculative venture.
And the fact that they haven't done that buyback is what confirms the market's worst fears. It signals that they're not prioritizing fixing the valuation right now. They're prioritizing this massive, expensive, high-stakes pivot. That decision tells you the $132 million is already earmarked for spending, not for returning to shareholders.
So that decision right there, it transforms this from a safe value play into an all-or-nothing bet.
Yes. It's a bet on management's ability to pull off a miracle before the money just runs out.
Okay, so let's talk about that pivot. Let's look at the actual business. What exactly are they spending $132 million on?
Well, the change has been really radical. The company used to be called Conexa Sports Technologies.
Conexa Sports. Okay, what did they do?
I think legacy sports stuff. Digital scoreboards, that kind of thing.
Yeah.
Traditional low-growth tech. In late 2025, they completely shed that identity and rebranded as RWA Inc. It was a hard pivot, funded by all that cash.
And they adopted this two-pronged model, right? Which sounds pretty aggressive.
It is. The first prong is probably the safer of the two. It's what they call AI matchmaking.
AI matchmaking.
Yeah, they're using some of their old AI patents, probably from their sports tech days, and applying them to digital matchmaking in other sectors, trying to get some steady revenue going.
Right, like a lifeboat. Keep one part of the business afloat while you build the battleship.
It's a perfect way to put it. And the battleship, the second prong, that's the RWA exchange, and that's where all the speculation is.
RWA, real-world assets.
This is the massive bet. It's one of the hottest narratives in Web3 right now. They're building a platform to tokenize real-world assets.
And not just any assets, they're focusing specifically on U.S. stocks.
That's the key. Putting regulated securities on a blockchain.
Okay, we need to slow down here for a second because the entire thesis hangs on this.
Sure.
How does tokenizing, say, an Apple stock actually work? And why is it worth betting $100 million on?
Well, it's complex, and that's part of the danger. But essentially, you're creating a digital token, a smart contract, that represents ownership of a share of a real underlying U.S. stock.
So the token on the blockchain is backed by a real share of Apple sitting somewhere.
Exactly. And the proposed benefit is, 24/7 trading, faster settlement, fractional ownership, making it easier for global investors to get exposure.
And they've actually put money behind this. This isn't just a white paper.
Not at all. In October 2025, they made a very public strategic investment of $30 million.
$30 million? Into what?
Specifically into Solana-based tokens to basically fuel this new exchange.
Wait, Solana, why Solana? I mean, why not Ethereum, where a lot of the institutional money is?
That choice really tells you everything about their risk profile. They chose Solana for speed and for its really, really low transaction costs. If you want to compete with TradFi, with traditional stock exchanges, you need thousands of transactions per second. So by betting on Solana, they're trying to be the fastest, cheapest bridge between the old financial world and the new DeFi world.
But if Solana has issues, if the network goes down or something?
Their entire infrastructure is at risk, instantly.
So they're just using their big cash pile to buy their way into the fastest, riskiest corner of the market.
Pretty much.
Which brings us right back to this central problem, the burn rate. That $132 million is a nice safety net, but how fast is the clock ticking?
That's the whole game, the runway. That cash only matters if it lasts long enough for this RWA exchange to actually work.
And the burn is aggressive.
Very. We know from the filings they recently burned through about $30 million in operations. That includes that Solana investment and just general development costs.
So, okay, at a burn rate of $30 million a quarter, what does that give them?
It's stark. It gives them about 4 quarters. 1 year.
1 year.
They have 1 year before they hit a wall. They either have to be wildly profitable by then, which is unlikely, or they have to go and try to raise more funds.
Which means diluting the stock for everyone who holds it now.
Exactly. So that 1 year clock is the absolute non-negotiable deadline on this whole investment idea. It has to show serious signs of life within that window.
And you can see that deadline, that skepticism, just baked into the company's valuation metric.
Oh, completely. The metrics are just extreme. You look at the price-to-book ratio, the PB, it's sitting around 0.15.
0.15. Put that in context for us.
A PB that low usually means one of two things. Either there's massive fraud happening that we don't know about, or the market thinks the company is actively liquidating and going bankrupt.
So trading at 15% of your book value is the market screaming, we don't believe this cash will ever get back to shareholders.
That's exactly what it is. And the price of sales is just as bad, around 0.22. It's just deep skepticism about their ability to execute.
It's all about that execution risk under a brutal deadline. Okay, but let's talk about recent market action. Because something did happen recently. The stock had been sitting at a floor, right, around $1.15, $1.20.
Yeah, that's basically its cash value per share, the liquidation floor.
And then as of January 14th, we saw this sudden spike. It jumped like 15% after hours, up to around $1.46. What was behind that? What were the catalysts?
It seems like a few things are happening at once. First, you have that technical floor. When a stock hits its cash value, it often attracts short-term buyers and forces short sellers to cover their positions, which can create a bounce.
The technical reversal. Okay.
Second, and this is probably more important for the future, is the narrative. The whole tokenization of assets, or RWA story. It's just exploding in early 2026.
Right. It's a hot sector.
A very hot sector. And this company, YYAI, is like a pure play high beta bet on that trend. So when the broader crypto market moves, stocks like this one tend to move first and harder in anticipation.
So people aren't buying it for the AI matchmaking side. They're using it as a levered proxy for the RWA trend.
100%. It's a high beta bet. And the third catalyst is just good old-fashioned anticipation. Small cap stocks don't just spike like that for no reason. It often happens right before a press release or some big news.
So we should be watching for an announcement.
Definitely. Watch for news about the RWA exchange launching its beta, or maybe a new partnership that validates what they're doing. That feels like the next big inflection point.
But even with those potential catalysts, we have to talk about the huge risks here. This is the very definition of a potential value trap.
Without a doubt. The number one risk is still that the cash just goes poof. If management spends that $132 million on a failed launch or a bad acquisition, then the market was right all along.
And the cash is gone. And you're left holding a business the market thinks is worth negative $85 million.
Precisely. And we can't ignore management's history here. You mentioned volatility. We have to talk about that 1-for-50 reverse split they did in late 2025.
Yeah, 1-for-50 split.
That is an act of pure corporate desperation. It's a massive, massive red flag.
It's what you do when your stock price has collapsed and you're about to be kicked off the NASDAQ queue.
It's a corporate defibrillator. You only use it when you're on the brink. It signals extreme prior mismanagement and fragility.
And then there's the final risk, which might be the biggest of all, the regulatory one.
It's immense.
Yeah.
The entire foundation of their new business, tokenizing U.S. stocks, is under a huge microscope from the SEC.
Regulators are still figuring all this stuff out.
Exactly. If the SEC comes down hard and says these tokens are unregistered securities, it could completely cripple their entire business model before it even gets off the ground. They're building on a very unstable regulatory foundation.
Okay, so let's bring it all back. What does this all mean for someone looking at this? How do we put all these risks and rewards together?
The analysis report is pretty clear. It frames this as a high-risk, high-reward speculative buy.
Speculative being the key word.
Key word. This is absolutely for investors with a high tolerance for risk who understand they're betting against the clock.
So you're betting that management can pull this off, can navigate the SEC, and launch the RWA exchange before that one-year cash runway just disappears.
It's a literal race.
But the reason people are even considering that bet is the sheer size of the potential upside.
Of course, that $1.20 to $1.25 zone seems to be the floor, liquidation value. But if the company just manages to trade at its book value, which is not an unreasonable target for a stable company.
You'd be looking at a stock price in the $4 to $5 range.
Exactly, which is a potential 3 to 4 times return from where it is now. That's the reward you get for taking on all of that execution risk.
A huge potential reward for huge risk.
And I guess that leaves us with the final provocative thought here. What we're really watching is a live experiment, a high-speed test in converting raw liquidity into a vision. You have the physical, undeniable safety of $132 million in cash on one side, and on the other, you have this hyper-speculative, unproven idea for a Web3 exchange. And the market is just waiting to see if management can turn that cash into real enterprise value before the burn rate turns that enterprise value into dust. That race defines the next 4 quarters for YYAI Inc.
A phenomenal summary of a truly fascinating high stakes.
Don't forget to like, share, and subscribe for more.